In this video, we're going to continue a discussion of capital structure and the choices that managers make when deciding how much or when to seek outside or external sources of financing. So in this case, we're talking about perfect capital markets. And Modigliani and Miller initiated this analysis actually quite early. It was actually in the late 50s, early 60s. They were asking these questions about financing, and essentially what their theory talks about. In this case, we're talking about the comparison of leverage with firm value. Basically, the law of one price implies that leverage will not affect the total value of the firm. It merely changes the allocation of cash flows. And as we've seen in previous videos, there is just really an exchange, if you will, between creditors and shareholders of the cash. So if the cash flows of the company are the same, then the value of the company is the same. So let's just kind of go back and review real quickly. What does a perfect capital market mean? It means investors and firms you can trade the same set of securities. They're competitive market prices, right? So they're appropriately valued assets. There's no taxes, transaction costs, or issuance costs. Costs associated with the security trading, and the financing decisions don't change the cash flows of the investments, nor do they give us any more information, right? So essentially what this is saying, this is a very sterile world. There's no transactions or commissions. The transactions that we take, once we look at them, those transactions are not going to be changed by the financing method. So in perfect capital markets, the total value of the firm is equal to the market value of the total cash flows generated by its assets. Again, therefore, it's not affected by its capital structure choices. So again, just to kind of, I know we're kind of repeating this a little bit, but it's kind of the same context in a different way, right? So in the absence of taxes, the total cash flow paid out is equal to the total cash flow generated. I mean, if you kind of think about this example, let's say a company wants to pay you $100 and you're an investor. We live in a world with no taxes. So does it matter if the company says this $100 is interest or this $100 is dividends? In a world without taxes, as the investor, you don't care because you get $100 and you can spend $100 because there's no taxes. What about the corporation? Likewise, since there's no taxes, they do not get a benefit from borrowings, right? There's no interest expense that they have to worry about. So it doesn't matter to them either. So in this case, the cash flows don't change based on the investment and how you actually finance this. So how this mechanism, I guess, is kind of illustrated is through a concept of something called homemade leverage. And basically what this means is if the company has a financial structure and as an investor, you don't like that structure. You like the company, you want to invest, but you don't like, for instance, you don't like how much debt they have. Well, you can create your own portfolio that undoes, if you will, some of that debt through your own investment portfolio. So what this means is if investors would prefer an alternative structure, they can borrow or lend on their own and get the same result. So let's assume you have no leverage and we create an all equity firm. And then there's an investor who would really want to hold some levered equity. They want a 50% capital structure. So how can they do that? Well, here's the unlevered equity, 1,000, 1,400, 900, and this margin loan. So you're going to borrow $500, and of course that has its own requirements. Now, if you look, this levered equity now matches the levered equity if the corporation had done the borrowing. So all homemade leverage says is that the outcome is the same regardless of whether you borrow or whether they borrow. So again, we can do the exact same thing. Assume that you use debt, but the investor would prefer unlevered debt. You can do the exact same thing and again, unwind this by buying debt has this outcome. Now you're back to the unlevered equity cash flows from the previous example. So in any case, your choice of capital structure does not affect the opportunities available. So you can alter the leverage to suit your personal tastes. Different choices of capital structure offer no benefit to investors and do not affect value in this perfect capital market. Now, just as a reminder, we don't live in that world, right? So this is just a very basic theory that has sterilized the world to understand how debt impacts borrowing. So let's think about a market value balance sheet, for instance. All assets and liabilities of the firm are included, and we find their market value. Even intangible assets, right? How do you find prices for those? It's very difficult, obviously, and certainly things like human capital, they're missing from a standard accounting balance sheet. So we have to, if you're going to do a market value balance sheet, we have to figure out a way to imply what the values of those things are. So the total value of all securities issued by a firm equals the total value of the firm's assets, right? So here we have, here's the market value of firm's assets. Again, note here under the intangible side, they have included this human capital piece. That has to be equal to the right side, which is the total market value of the firm's securities. Now, I think if you really wanted to understand how market values affect the firm, we can find market values for these tangible assets. We also can find the market values for debt and equity. So if you took tangible assets, the market values, you subtracted the market value of debt, market value of all these equity components, that would leave you with the market value of intangibles. And I think that would be a really interesting relationship to explore, to try to see, well, what are the values of these underlying things like reputation, intellectual property, human capital, right? Because in the end, when you buy a corporation, you also buy its workforce, you buy its reputation. So they have value. But what is that value? So again, this is just that formula. The market value of equity minus the market value of assets is the market value of debt and other liabilities. So we can find and solve for this true market value of equity if we wanted to. Now let's look at one little example of what's referred to as a leveraged recapitalization. So what does that mean? We're going to borrow some money, and we're either going to pay a special dividend or we're going to repurchase outstanding shares. So we're using debt to alter the financial structure of the right-hand side of the balance sheet. So we have this all-equity firm, perfect capital market, 15 million shares trading at $4. We're going to increase our leverage by borrowing 80 million and using those funds to repurchase 20 million of its outstanding shares. So we're going to rebuy the stock. How does this affect value in a perfect capital market? Well, here we go. Here's the beginning company, 200. We're going to borrow 80. Here's our debt. So that takes us up to 80. Now, what happens here is we haven't done anything, so we still have 50 million shares. Equity is still the same, so it's $4. Now we're going to go out and we're going to take that cash and buy back some of the equity. So now if you notice, the balance sheet obviously changes, and we also change the number of shares. So now we have 200 shares, or 120 million in equity, and we have $4 or $30 worth of, or 30 million shares. So 30 million into 120 million means the value of the stock is still $4. Again, because both assets and liabilities increase by the same amount, the market value of the equity remains unchanged. So again, Modigliani and Miller in this initial theory have stated that the capital structure, how you choose to finance the company, does not alter the value of the company. And again, as I've said a couple of times, I think this is a little confusing, right? Because it just doesn't really make sense. Well, it doesn't make sense in the context of real life. This is a theory that has sterilized most of the world, right? We're at a zero tax position, and we know we don't live there. Look forward to seeing you in the next video.